Most parents spend about $50,000 to $100,000 on college housing and get back $0 from it. But what if instead your kid's housing actually made you money, reduced your taxes, and built equity for the family? Because that's exactly what some of the high income families are doing by buying a property before their kid even starts college. And if you structure it right, you may be able to even use strategies like accelerate depreciation in year one to offset income. In this video, I'm going to break down exactly how this works and why timing is everything. The first step here is planning ahead. Where is your kid actually going to college? Is it a major university with strong rental demand? Are there areas around the campus where students consistently rent out year after year? You don't want to wait until they're accepted and then start scrambling. You ideally want to start buying 1 to 2 years in advance. Why? Because that gives you time to find a good deal, set up the property correctly, potentially rent it out even before they move in, and more importantly, it opens up tax strategies opportunities inside that first year. This is where things get interesting from a tax perspective. If you buy the property before your child starts living there, you can treat it purely as an investment property initially. That means you may be able to use a cost segregation study, accelerate depreciation, potentially qualify for real estate professional status if obviously that applies to you, or use it as a short-term rental to bypass passive loss limitations. That first year is so critical. So the play here is buy early, rent it out, maximize depreciation, then transition it when your kid moves in. This is where a lot of people start leaving money on the table. They buy too late and miss that window. I actually learned this from one of my mentors who actually had a client execute this strategy very well. The client's kid goes to school in Utah. She also had friends go along with her and rented out 3 of the other bedrooms. Keep in mind, the kid also had to pay her fair share of the rent. The funny thing is, 3 of her friends actually paid 90% of the mortgage, and when the kid paid the property, that actually turned it into a cash flowing property. In the meantime, the kid helped manage the property, cut the grass, handle electrical, manage her tenants, which is also her friends, manage the lease, all while building real skills such as a property manager and slowly becoming a landlord. The parents was able to leverage the depreciation and make that cash flow tax-free. And I don't think they actually did this also, but it is an extra strategy they could have done, is paying the kid to be a property manager. Even though the kid was over 18, they can still file their own tax return, take advantage of the standard deduction, and any amounts paid over the standard deduction will be at a lower tax bracket than the parents. Now, I'm not sure if they took advantage of the tax strategy of shifting income into a lower tax bracket, but the key takeaway from the story is that the earlier you plan, the more flexibility and tax leverage you have. Now, let's talk about what happens after your kid graduates, because this is where you can really win. You've got a few options, right? Option 1 is keep it as a rental, right? You've already established that there's a proven rental market, arguably one of the most consistent tenant pools out there, because kids have to actually live somewhere and attend college, right? Option 2 is convert it into a full investment or a short-term rental, especially if it's in a desirable area, right? College football comes around and it's always busy, and you can rent it out during the short-term periods of the weekends for that, okay? Option 3 is sell the property. You've built equity for, let's say, over 4 years now, if the student or the kid is attending college, and you can potentially build appreciation on top of that with the equity you've built in. Okay. Option 4 is 1031 exchange into another property, roll that equity into maybe something bigger without immediately paying taxes. And this is where it becomes very unique, because maybe the kid goes to graduate school and goes to another area. You can always 1031 exchange into a different area, go back into your city. There's some options that you have there with essentially moving that property around, right? The key is you're not stuck. You've created options for yourself and potentially your kids. Let's break down the strategy, why it's so powerful. Instead of paying rent, you're building equity. Instead of covering housing, you could have roommates covering most or all of the mortgage. And instead of getting no tax benefit, you may be creating depreciation that offsets some of your income. And instead of your kid just going to school, they're actually learning how real estate works. On top of that, there could be opportunities to legitimately pay your kid for work, related to the property, potentially shifting income to a lower tax bracket. This is what separates people who spend during college from people who actually invest during college. Same expense, completely different outcome. If you're a high income earner, contractor, or business owner, strategies like this can seriously compound over time. If you want more breakdowns like this, real estate, tax strategies, and how to actually keep more of your money that you work so hard for, consider subscribing and I'll keep these coming. We'll see you in the next one. Bless.